Chapter 14, Long-Term Liabilities. In this chapter, we're going to look at notes receivable, bonds, and installment loans. We'll look at the debt to equity ratio, and that will happen at the end of the video, and I will show you why we use the debt to equity ratio, and you'll see this again when we get into chapter 17. Okay, compare bond financing with stock financing. Okay, when you invest in stock, a company receives money for a share of ownership for their company. When you get a bond, the company issues a bond similar to how they issue stock, but instead you do not receive a piece of ownership with a bond. The corporation will issue the bond, you will give them the money as an investment, and then they will give you a series of interest payments for the duration of the bond. Then at the end of the bond period, they pay back the money. So you will earn your money back plus the interest payments. Some of the advantages to having a bond is it does not affect owner control. So if a company is worried about someone buying too much stock and overtaking the company, this is a good alternative. Bonds are also tax deductible. A disadvantage is that the bonds require payment of both periodic interest and the par value at maturity. So for the duration of the bond period, you are paying them money. And depending on what the market is doing, bonds can increase or decrease your return on equity. That depends. This is what a bond certificate would look like. It has the information of how much it is, when it was issued, a description number, and then your name. Now, bond trading. Bonds are securities, and they can be purchased in the securities market. And they are expressed as a percent of par value. Par value is 100%. So this one closed at 103.08% of face value. What that means is if the bond were for $100, par value would be 100. This closed at 103.08, which means it closed at $103.08. Okay, let's look at the entries and how to calculate the interest expense. Okay, in this example, a company has issued a $100,000 bond, which is very common, and that is the par value, which means that is 100% of the bond. The stated interest rate is 8%, and this is a 2-year. It matures in 2 years, and there are interest dates of June 30th and December 31st, which means it's semi-annual. They will make a total of 4 interest payments, 2 years, 2 payments each year is the 4. When you sell a bond, the journal entry is done on the date of the sale. You will debit cash, the amount of the bond, which is $100,000, and then you credit bonds payable. So you increase your cash and you increase the amount of money you owe. You now have a liability, a long-term liability of $100,000 in bonds payable. Let's look at the first interest payment. For the first interest payment, which will be June 30th, the calculation that you take is the $100,000 times the 8% times the half of year. You could do 6 months over 12, or you can just do 1/2 of year, or 0.5. And that equals $4,000. You will actually send them the interest payment of the $4,000, debit bond interest expense. You have to recognize the expense that has incurred and credit cash $4,000. You will do this twice a year. Okay, the second interest, well, this one is actually how to record issuing a bond at par at maturity. Now, at maturity, you've already made all your interest payments, and that is the money that the bond holders actually get. So at the end of the 2 years, you give them their money back, which will be a credit to cash, and then you debit bonds payable to take it off of your books because you don't owe the money anymore. Okay, let's look at a practice problem. In this one, on January 1st, Brussels Enterprises issues bonds at par, which is 100%, January 1st, 2019. The par value is $3.4 million. They mature in 4 years, and they pay 9% interest semi-annually, June 30th and December 31st. Okay, we're going to work on 4 journal entries. The first one is the issuance of the bond. So I'm just going to kind of underline a couple of things. The par value, it matures in 4 years, 9% interest. Okay, so to record the entry for the bond, it's dated January 1st, 2019. Debit cash, $3.4 million, because now we have that. Credit bonds payable for $3.4 million. Your first interest payment is on June 30th. To calculate that, you'll take the amount of the bond, $3.4 million, times the 9%, and you divide it by 2. Another way you can do it is multiply it by 0.5, which is half a year. That's $153,000. And then you debit bonds interest expense, the same $150,000. This is to record interest for the first interest payment of the 2 years. Okay, so we did number 1 and we did number 2. Number 3 is to record the second semi-annual interest payment, and it's the same thing. You're still taking half a year times 9% for the amount of the bond. Okay, you do this 2 more times for the year 2020, and then it matures, 4 years. So you do this for 3 more years, and then at December 31st, 2022 is when the bond matures, and you're going to take it off the books because you're cutting them a check and giving them their money back, and then you credit cash, the $3.4 million. Okay, not all bonds are going to sell at par. Some are going to sell for a discount and some are going to sell for a premium. Bond prices usually work the opposite of stock prices or other investments. And usually when you're looking for an investment, you want something that has a high yield, a high interest rate that you will get back. So when the market is higher than the bond market, it is harder to get people to invest in bonds. So what they do is they will have to sell their bond at a discount to attract investors. If the contract rate for the bond is higher than the market rate, more people are wanting to invest in bonds. That is a case where you can actually sell your bond at a premium, which is more than par, more than 100%. When you sell it at a discount or a premium, that difference between the par value and the amount you sell it for needs to be amortized over the life of the bond. Straight line depreciation is used for that. Okay, let's look at this bond. The par value is $100,000 and they issue it for 96.4%, which is below par value. So that means we're selling it at a discount. The stated rate is 8%. The market rate is 10%. So if you want to earn more money, you could invest in something else at 10%. But they want a bond and they've already issued the bond at 8%, so they can't change the interest rate because this is already issued. So how they attract people is instead they will discount the bond to give them 10%, but they can't change the interest rate, so they can give it to you for less. And that is the difference between the 8% and the 10%. And you'll see that as we finish going over the discount of the bond. The interest rates are still June 30th and December 31st, so it's semi-annually. The bond issue date is December 31st, 2019, and maturity date is 2 years later, December 31st, 2021. Okay, par value is $100,000. And we are only going to get 96.4%, because remember, 96.4%. So if you take 100,000, let me see if I can write this. $100,000 times 0.0964, you get 96,400. That is the amount that the bond is going to sell for. This is a $100,000 bond. So what happens here is at the end of these 2 years, the company is going to give the bond holder $100,000. But they don't have to give the company $100,000. They only have to give the company the $96,400, and then they will still get the $100,000 at the end. That's where the discount comes in. If they issue it at a lower rate, at a lower amount, but still give them the full amount at the end, they end up earning an extra $3,600, which makes up for that 2% discount, the 2% interest difference. The bond is issued at 8%. The market rate is at 10%. This $3,600 extra money that they're getting will make up that 2% difference. And this will help bring people to the bond market rather than investing in the 10% market. When you first sell the bond, what we've done when it's sold at par value is you debit cash the $100,000 and you debit cash $100,000 and credit bonds payable $100,000. When it's issued at a discount or a premium, it's a little different. You still debit cash, but you debit cash for the discounted portion, which you take the 96.4%, and that is the amount that the bond holder is going to give you is the 96.4. So you debit cash for the 96.4. You credit bonds payable for par value, which is the $100,000, and then that $3,600 difference is the discount. It goes into discount on bonds payable. Discount on bonds payable is a contra liability account. If you remember from the accounting equation, liabilities are on the right-hand side of the accounting equation. So it's the right-hand side of the T account. That's the increase side. So liabilities increase on the credit side. This is a payable, which is a liability, but it is on the debit side. So this is considered a contra liability account. Okay, now let's look at what we do with this $3,600. We know that the carrying value is the $96,400. That's the amount that they originally gave us. How now this $3,600 we have to amortize. So what we're going to do is this is a 2-year bond, and we make semi-annual payments. So we will be making an interest payment 2 times a year, which is 4 payments in the 2 years. Take the $100,000 times the 8% times half a year, or 0.5, and multiply that by 4, and you get $16,000. We will pay them a total of $16,000 in interest. This is the interest. It's hard to write on my screen. Okay. And then you add the discount plus the discount of $3,600. So we're actually going to give them, in this 2-year period, twice a year, it will end up being $19,600. We're going to take that $19,600 and divide it by 4, because that is how many payments we're going to give them. 2 semi-payments every year, and this is a 2-year bond, so that's 4 payments in 2 years. Each payment, we are going to give them $4,900. We will actually, that's the amount that we expense out. We will debit here bond interest expense for the $4,900. We will credit cash for $4,000, which is the amount of the interest. It is par value times the contract rate, which is 8%, and then you multiply it by 1/2 or 0.5. That difference goes into discount on bonds payable, and that goes to $900. Okay, now let me show you what bonds payable looks like here. Okay, so here is discount on bonds payable. Okay, remember this is a contra liability account, so it actually holds a debit balance. So we have a debit balance of $3,600. When we get done amortizing this bond at the end of the 2 years, the discount on bonds payable is actually going to be 0. Okay, so we have 4 interest payments that we're going to make. The first interest payment, we credit bonds payable $900. And then we'll do it again for the second interest payment of the first year, and then the first interest payment of the second year, and then the second interest payment of the second year, and then discount on bonds payable at that point will actually be 0. Okay, now this is an amortization chart over the course of the 2 years, which includes the carrying value of the bond and the unamortized discount. Okay, and as you recall, they issued it for $96,400, which was a discount of $3,600. If you add the two together, that's going to equal $100,000. Okay, you know how here's the discount on bonds payable. We had $3,600, and then that first was a credit of $900. That leaves us a balance of $2,700 after the first payment. So when we make the first payment, $3,600 now is not unamortized because that we just amortized $900. So now the balance is $2,700, which shows it right here. And now the carrying value of the bond increases by the amount that we just amortized. So what we do for each time is let me see if this is going to work. We decrease what is unamortized and turn it into amortized. And then on this, we increase the carrying value by $900. And the two added together will equal $100,000. If you take the carrying value of the bond plus the unamortized discount portion, it will equal the par value of the bond. This is actually the same process as we went through when we did depreciation. If you take the amount you paid for the equipment plus accumulated, and then you subtract accumulated depreciation, that's your book value. So the carrying value is similar to the book value. So this is the same process as we did with the depreciation. Now, when we get done with the last payment, the fourth payment of interest, we will have amortized it all, and then this account would be at zero, like I showed in the previous slide. And now the carrying value is at the full par value of $100,000. Okay, let's practice a problem. Okay, Tano issues bonds with a par value of $180,000 on January 1st, 2019. The annual contract interest rate is 8%, and par value is $180,000. Semi-annual, so it's twice a year, payments on June 30th and December 31st. The bonds mature in 3 years. I'm going to put a number 3 and circle it. The annual market rate at the date of issuance is 10%, so the market rate is 10%, and the bonds are sold for $170,862. They sold them for below par value, which means they sold them at a discount. Sold at, okay, that does not look like it. Sold at a discount. Okay. Okay, let's look at this here. What is the amount of the discount of these bonds at issuance? We take the $180,000 and then we subtract the amount that we sold them for, and we get $9,138. This is the amount of the discount. This is the amount that we need to amortize. How much total in bond interest expense will be recognized over the life of these loans? To figure out what your interest payment is, take the par value of $180,000, multiply it by 4%, which is half. It's the same thing. We could have done $180,000 times 8% times half a year. But half of 8% is 4%. So this is just an abbreviated way of doing it. So take 4% times $180,000, and we get $43,200. Over the course of this bond, we will pay interest of $43,200. Plus the bond discount that we just calculated, the $9,138, gives us to a grand total of $52,338 of interest, technical interest, that we need to recognize over the life of the bonds. Let's look at how we're going to amortize them next. Okay, this is 3 years. And we make two semi-annual payments a year, so we will make 6 interest payments. We're going to calculate the how to amortize them. On January 1st, we have a carrying value of $170,862, which is the amount that we sold it for. And the discounted amount is $9,138. If you add the two together, you will get $180,000, which is the par value. We will be making 6 payments. So take the $9,138 and divide it by 6, which is $1,523 per interest payment. In discount on bonds payable, we have $9,138 as a debit balance. We will credit the account $1,532, which will leave you a balance after the first payment of $7,615. Then add that $1,523 to the carrying value, and that's $172,385. And just to double check, add those two numbers together, and you should get $180,000. The second payment, after you amortize, you will decrease the portion that you amortize by $1,523, and then you'll add that amount to the carrying value. And again, it will equal $180. Then you subtract another $1,523, and then add that $1,523 to the carrying value, and so on until you get to the end. The very last one, you will amortize the last $1,532, which will then bring your carrying value to the full par value of $180,000. Okay, that was looking at a discount when you sell the bond at a discount. Now we're going to look at selling it at a premium, which actually is exactly the same thing. The only difference is which side we're going to put it on, but it works exactly the same way. With this one, it's issued at 103.6, which means that's more than par value. So we are selling it at a premium. The market rate is 10%, which is less than the bond interest rate, which is 12%. When the interest rate for bonds are higher, more people are wanting to buy bonds instead because they earn more interest. And you know that when something is highly desired, the price tends to increase. Because it's highly desired, people are still willing to purchase it at a higher price. So they're able to sell these bonds for more than what they're worth because people are wanting the higher interest rate. In this example, we have a 2-year bond, 2 semi-annual payments like we've been doing. Okay, same process here. The par value is $100,000. The cash proceeds, which is the amount that the bond person, the bond that what we're going to get, is $103,600. So we're selling it at a premium of $3,600. We will receive. Now this is the interesting part. We will receive $103,600, which is the premium. Now instead of having a discount of the $3,600, we have a premium of the $3,600. At maturity, in 2 years, we will give them only $100,000. We only give them the par value. Okay, so we're going to give them the par value, but they gave us a premium. They gave us $3,600 more. And this is because they're earning more interest than what they would normally earn anywhere else. So we can charge them a premium. They will still buy it. When we had a discount, we debited discount on bonds payable, But this is a premium, so instead of a debit, it's a credit, and the account is called Premium on Bonds Payable. The carrying value is $103,600. Okay, let's calculate how much our interest is going to be. This is a 2-year bond, which means we will be making 4 interest payments. Take the par value times the interest rate times half a year, and then times 4 payments is $24,000. We will be giving them interest over the course of the 2 years for $24,000. We're making 2 semi-annual payments for 2 years, so that's 4. Divide that by 4. Each payment consists of $6,000. Now we need to subtract the premium of $3,600. So the total bond interest expense is actually only $20,400. Now we need to divide that by 4 to see how much each payment is. Divide the $20,400 by 4, which is how many payments. We will get $5,100 that we need to expense out every semi-annual payment. Debit bond interest expense, $5,100. Credit cash, the full $6,000. The difference is $900. That goes to premium on bonds payable. Okay, I'm going to do the same thing as I did before with the discount. Here is premium on bonds payable. We had a debit balance of $3,600. Oh wait, I'm sorry. How do I erase that? Let me try this. Erase. Ah, it works. Okay, we had a credit balance of $3,600. Now we're going to debit premium $900. You know how when we had the discount, we amortized a portion off every interest payment, and then by the last interest payment, discount on bonds payable was 0? The same thing here. We will amortize $900 for each interest payment that we make, and then at the end of the 2 years, the premium on bonds payable will be at 0. Same thing as with depreciation. Okay, this is an amortization schedule, and it works exactly the same way. By the end of the by the end of the bond period, the carrying value will be $100,000, which is always the par value. Well, $100,000 isn't always the par value, but at the end, at maturity, your carrying value will be at par value. What we did with the discount is we subtracted $900 each time, and then we added $900 to the carrying value. Because this is a premium and not a discount, instead we subtract $900. So we subtract $900 from our unamortized because we amortized it. Then since we sold it at a premium, we also subtract $900 from the carrying value. And again, it's always going to equal $100,000. And then you do the same thing for the rest. Okay, let's practice a problem. Wookey Company issues 10% 5-year bonds on January 1st. Par value is $200,000 with semi-annual interest payments. They use straight line, and this is a 5-year bond, and they issue it at 10%. Okay, let's look at the journal entry to record. The issuance, the carrying value is $216,222. So that is saying that that is what they sold it for. So they sold it at a premium. Debit cash, the $216,222, and credit premium on bonds payable, the $16,222, which is $216,222 minus the $200,000 par value. And then credit bonds payable for the $200,000, because that's all that the company has to pay back at the end. Okay, the first interest payment, take the par value of the $200,000 times 5%. It is a 10% bond, but again, this is for half a year. Can't finish there. So half a year, so it's only 5%. Or you can take 200,000 times 10% times 1/2, and that will give you your 5% anyway. So we'll credit cash 10,000, give them an interest payment of 10,000. Interest expense is $8,328. Okay, the second interest payment. Okay, then the second interest payment is going to work the same way with the same numbers. Okay, let's look at the retirement of the bonds now. The retirement of the FILA bonds at maturity for $100,000 cash. When it is issued at par value, it's just simply bring bonds payable to zero, which would be a debit of $100,000, and then credit cash $100,000, because now you're giving them their money back at the end of the bond. Sometimes you will retire the bond, which means you will call the bond to payment before maturity. If the carrying value is greater than the retirement price, then you will get a gain. If the carrying value is less than the retirement price, you will have a loss. So let's assume $100,000 of callable bonds will be retired on July 1st, after the first interest payment. The bond carrying value is now $104,500, and the bonds have a call premium of $3,000. A call premium means if a company decides to call their bonds into retirement before maturity, they need to pay a penalty. So this is basically a penalty of $3,000 for calling them early. And what they mean by callable bond is someone can invest in a callable bond or a non-callable bond. A non-callable bond means they have to keep it until maturity. A callable bond means anytime after a certain date, they can call the bond and bring it to maturity early. A reason why they would want to call a bond is if the interest rates had changed to where the market interest rate is lower and the bond interest rate is higher, they can call all of their bonds and then reissue them at a higher rate and earn more money. So that would be one reason why they would want to call a bond. Callable bonds, that's the only difference between a callable bond and a non-callable bond. Okay, how you would work this is you would, because you're retiring the bond, you need to zero out your bond payable account. And since this was a $100,000 bond, you would debit bonds payable to bring it to zero. And then your cash would be $103,000. The $100,000 for the bond, and then the $3,000 for the retirement. And it says that the bond carrying value is $104,500, which means what's left of unamortized of the bond is $4,500. So we would have to zero out that, which would be a debit to premium on bonds payable. Now the difference is the plug figure. It's what do we need to get this to balance? We need a $1,500 credit to balance this journal entry, and that would be the gain on the bond retirement. Another option that can be done is to convert the bond to stock. And the same thing here, you would want to debit bonds payable $100,000. And we haven't gone over stocks and corporations. Well, actually, yeah, we have. No, we haven't. So, wait, yeah, we have. So, you know that with common stock, you can only put up to par value in common stock, and anything over par value goes into paid in capital in excess of par value. In this case, par value is $2, and they're converting their $100,000 bond to 15,000 shares of $2 par value. 15,000 shares times the $2 par value is $30,000. Bonds payable is worth $100,000. Which means $70,000 is paid in capital in excess of par. Okay, let's work on a practice problem. Tyrell Company issued callable bonds with a par value of $10,000. The call option requires Tyrell to pay a call premium of $500 plus par, which is a total of $10,500. We're going to look at two situations. We're going to look at if the bonds had a carrying value of $9,000, and then we're going to look at if the bonds had a carrying value of $11,000. So you can see if one has a discount and one has a premium. Okay, so let's look at the carrying value of $9,000. The bond par value is $10,000, so that's what was put into bonds payable. So we will have to take it out of bonds payable to zero out that account. And that would be a debit of the $10,000. The discount on the bonds payable is $1,000 because you see that the carrying value is $9,000. $10,000 minus the $9,000 is $1,000. And we're going to give them $10,500 in cash, which is the $10,000 par value plus the $500 call option. The gain or loss is calculated as the difference between the carrying value of the bonds and the amount paid to retire the bonds, which would be $1,500, and that would be a loss because they are paying out more than what the bond is worth. Okay, let's look at this time carrying value of $11,000. Bonds payable still has to be debited for $10,000 to zero out that account. Cash is going to be credited for $10,500, same as the first option, the $10,000 for the par value plus the $500 call option. In this first one, it was a discount of $1,000 because of the $9,000 carrying value. This time we have an $11,000 carrying value, which is more than the bond of $10,000. So we have a premium of $1,000, $11,000 minus $10,000. Then the difference, we need $500 credit to balance this journal entry. So we will credit gain on retirement of bonds. Now we're going to explain the types of notes and prepare entries to account for these notes. So we've looked at long-term notes payable before and notes payable before. Most notes payable are long-term. They're more than a year. And the main difference between accounts payable and notes payable is notes payable has interest attached to it. And that there is a certain date that the interest and the amount is due. You could have a situation where you don't pay anything on it until it's due, and then you pay all your interest and the amount that you owe together. Or you can have it in installments where you make interest payments periodically until the due date. If you wait until the maturity date to pay the note and the interest, that is called a single payment. You will pay one single payment at maturity, which is the amount of the loan plus all of the interest attached. Then you have a regular payment, which is you have regular payments of principal plus interest until maturity date. Now, this is considered an installment loan, basically, and some car loans, motorcycle loans, boat loans are installment loans. Okay, so let's look at this one. Fog Hog borrows $60,000 from a bank to purchase equipment. They sign an 8% note requiring 3 annual payments of principal plus interest. So this is once a year for 3 years, they make a payment. When they first get this note, they're going to debit cash $60,000 because they were given $60,000 so they could buy the machine, and then credit notes payable $60,000. We've been doing this journal entry, I think, since chapter 2. Now, you'll have a table value that you will use to multiply this by, and that's going to be given to you. And we'll look at that for the amount of the payment. This is a $60,000 loan at 8% for 3 years. So on the table, you would look up 8% going across the table and 3 years going down. And then where do the two meet? That's your table value. Multiply that table value by the present value, and you get $23,282. That is your annual payment. Now, we're going to go through, this is similar to the amortizing of the bonds that we've done. We have here beginning balance of $60,000. And then if you take that and multiply it by 8%, you get $4,800. That's the amount of your interest. Subtract your balance. So take your $60,000 minus your $4,800, and that is going to equal the amount that you debit to notes payable, which means debiting notes payable takes it away, saying, okay, I have paid out of the $60,000, I have paid $18,482 towards the principal. So note payable is actually the principal. And then the interest expense, of course, is the interest. Interest. Your interest plus your notes payable amount gives you the cash that's required for the payment. Okay. If you take $60,000 minus the principal, that gives you $41,518. That's what you have left to pay on the loan. That's not including the interest. That is only the principal amount of the loan. If that is the ending, okay, you know what? I'm going to start a note payable T account here. So here is the long-term note payable. Note payable has a credit balance of $60,000. And then we made our first annual payment of $23,282. But out of that $23,000, $18,482 went to note payable, and the $4,800 went to interest. So if we look at this at the end of year one, our balance in the account is $41,518. If we end year one with that amount, we're going to start year two with that amount. So the starting balance of year two is $41,518. To get the interest that we owe, we're going to take the $41,518 and multiply by 8%. That will give you the $3,321 in interest. We are still making the same payment of $23,282. But because the balance that we owe is decreasing, more is going towards principal and less is going towards interest. So out of the $23,000 payment in year two, $19,961 goes to principal, and $3,321 goes to interest. So we will debit note payable $19,961, which at the end of year two gives us a balance of $21,557. Which means that's what we start year three on. Take the $21,557 and multiply by 8%, and you get $1,725. Because this is our last payment, this is how much of interest we're paying. We will end up closing out note payable and have an ending balance of 0. Okay, looking back here, let's pay attention to interest for the first year is $4,800. Then note payable, we're going to debit $18. And then the payment is $23. These numbers are going to be over here. The journal entry to record that first payment, so that was a table to figure out what numbers we're using. These are the journal entries that go along with those numbers. So at the end of the first year, we're going to make our annual payment of $23,282. $4,800 goes to interest. That is $60,000 times 8%. And then the difference goes to notes payable to decrease the value, decrease the amount of what we owe. Okay, then this was at the end of year one. Now at the end of year two, we make that same payment of $23,282. But our balance was like $41,000 something, I think. Take that amount that was in the table, multiply by 8%. And you get $3,321. The difference between the two gives you what amount is going towards the principal. Okay, let's practice. Okay, Eagle Company borrows $100,000 cash, signs a 4-year, 7% installment note. And they have 4 equal payments, which means 1 payment per year. And that payment consists of $29,523. And that payment will be part interest and part principal. Okay, let's do an amortization schedule first. Okay. The beginning balance is $100,000. The interest is 7%. So take the $100,000, multiply by the 7%, and we get $7,000 of interest for the first year. We know that the payment that we're going to make every year is $29,523, so that will be the credit to cash when we get ready for that part. The difference between the $29,523 and the amount that goes to interest expense is the amount that goes to principal, $22,523. When you debit note payable, that is your principal. Take the amount of cash, subtract your interest, gives you the amount that you're paying on the principal, which actually pays down your loan. Then your ending balance that you owe, you started off the year owing $100,000. After your payment, you now owe $77,477. Your ending balance for year 1 is going to be your beginning balance for year 2. Okay, now for your interest for year 2, the interest is not going to be the same because you're going to calculate your interest on the amount that you owe. We don't owe the full $100,000, so our interest is not $7,000 anymore. Our interest is going to be 7% of the balance that we owe. 7% of $77,477 is $54.23. Now we know we're going to make the same monthly payment, annual payment of $29,523. Subtract our interest payment of $54.23. And that gives us the $24,100, which is the amount that we're going to debit to note payable to decrease what we owe, and that's the amount that's going towards our principal. Our ending balance is $53,377, which means that's what we start year 3 with. And then we go through the same process again. The $53,377 times 7% is $37.36. That is the interest that we owe for year 3. We still make the same annual payment of $29,523. Subtract the interest from that amount, and that tells you what is going towards the principal or to decrease notes payable. Our ending balance at the end of year 3 is $27,590. That's what we start year 4 with. And then we do the same thing. And our ending balance is now 0 because we've paid it off. Okay, now we're going to look at the journal entries for this. So the first journal entry is to recognize that we have a notes payable, which is to debit cash $100,000 and credit notes payable $100,000. Okay, now the second thing is to record the interest installment. That's $100,000 times that 7%. We will debit interest expense, $7,000, and then debit note payable, that $23,523, and credit cash for the $29,523 payment that we make every year. And then same thing, the year 2 and year 3 and year 4. These numbers all come from that table that we just discussed. Okay, the last part is mortgage notes. Mortgage is a legal agreement that helps protect the lender if the borrower fails to make the required payments. It gives the lender the right to be paid out of the cash proceeds from the sale of the borrower's assets, specifically identified in the mortgage contract. So we're just going to look at debit features and their implications. We've talked about convertible and callable bonds. Callable is when they can call it early before maturity. In convertible, we looked at that when you can convert it from a bond to stock. And secured means you have some sort of an asset that backs it up, like a mortgage. And unsecured would mean that they didn't. Okay, the last thing we want to do is just look at the debt to equity ratio and explain its use. The debt to equity ratio is total liabilities over total equity. And this helps investors determine the risk of investing in a company by calculating this ratio. Now, if a company needs to earn money or needs money for a capital venture or anything like that, they can do one of two things. They can get a loan, which increases their liability, or they can issue more stock, which increases their equity. You want a balance between the two. You don't want to be heavily leveraged in your liabilities and owe a lot of money, and you don't want to use all of your stock up in equity and have a lot of that. So you want a good mixture between the two. Okay, so let's just look at Nike and Under Armour and look at theirs. So 2 years ago, Nike had a debt to equity ratio of 70. If you have a ratio of 0.5 or 0.50, that means half of your debt is in liabilities, the other half is in equity. So a 0.7 means they have more liabilities, they owe more money than they've used their equity. And their current year has increased to 0.87. So if I were investing in a company, I would want to look at why are their liabilities increasing. And then Under Armour, they're almost at 100%, which means they owe twice as much money than what they have in equity, which is not good. You want a good balance between the two. Okay, let's practice this last problem. Okay, Montclair Company is considering a project that will require a $500,000 loan. Excuse me. It presently has total liabilities of $220,000 and total assets of $610,000. Okay, we're going to calculate their debt to equity ratio under a couple of different options. First is present, what they have right now. And then second, we're going to look at if they do decide to get this $500,000 loan, and we'll see how much it really makes a difference. Okay, currently their total debt is $220 and their total equity is $390. That gives them a debt to equity ratio of 0.56, which is really good. It's pretty much equal. If they were to get this loan, it would increase their debt to $720,000 and their equity would stay the same at $390. This increases their debt to equity ratio to 1.85. They have almost twice as much liabilities as they do equity, which is not a good idea. So this is just another example of debt to equity ratios, and we will go when we get to chapter 17, we will bring this ratio back and all of the other ones that we've talked about all semester long. Okay, so this is the end of chapter 14. If you have any questions, please let me know.